In this video I am going to be showing two ways of using the Bollinger Band indicator to generate consistent profits. But before we start, be sure to subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. Bollinger Bands were developed by a famous technical analyst named John Bollinger. By definition, Bollinger Bands is a technical indicator that plots lines that are calculated based on the standard deviation of a simple moving average. This is how the Bollinger Band looks. It consists of three lines. The middle line here is a simple 20-period moving average. The upper line is plotted based on two standard deviations above the 20-period moving average. Similarly, the lower line is calculated based on two standard deviations below the 20-period moving average. These two blue lines can also be called as the upper band and lower band respectively. The Bollinger Bands are very popular among traders because they help in determining whether the price is higher or lower on a relative basis. Throughout this video, we will use the Bollinger Bands on their default settings of a 20-period moving average with a 2 standard deviation. The distance of the bands is based on standard deviation and hence, they adjust to the underlying volatility of the asset. This means that in a sideways market, the bands become tight. And in trending market conditions, the bands become wide. 95% of the price action is contained within these bands. Hence, if the price comes near the upper band, we can say that the price is overbought and it may reverse on the downside. Similarly, if the price is near the lower band, we can assume the price to be oversold and an upside move can be expected. This is not always true. In a strong uptrend, the price can stay around the upper band for several candles. Similarly, in a strong downtrend, the price can stay at the lower band for several candles. The Bollinger Bands can also help in identifying stop loss and profit targets. For instance, if you place a buy order at the crossover of the middle band, which is the 20-period moving average, the upper band becomes your target. On the other hand, if you place a sell trade at the crossover of the middle band, the lower band becomes your target. Now that we have understood the basics of the Bollinger Bands, it's time to come to our first strategy. The name of the first strategy is the squeeze breakout strategy. This strategy is based on the fact that the market keeps moving from phases of high volatility to phases of low volatility. In other words, the price moves from ranging markets to trending markets. Hence, if we spot a low volatility market condition, we can expect a big move in any direction. Our goal with this strategy is to capture these big moves. For that, the first step is to find low volatility areas. Here is how a low volatility period looks. This is a 30-minute chart of the Amazon stock. Look at the middle band. It is as flat as a horizontal line. Another thing to note here is that the bands are extremely narrow. Both of these points indicate that the price is in low volatility. So, our first step is now complete. We have successfully identified and are of low volatility. The second step is to wait for the market to make a trending move. The trending move could be in any direction. Hence, we have to keep an open mind. According to this strategy, we sell when the price closes below the lower band. Similarly, we buy when the price closes above the upper band. Let us now skip a few candles. Here, the price closes below the lower band and hence we sell here. But look at what happened next. The price reversed and made a move on the upside. Hence, this was a false signal. How do we avoid these losses? In the early years of my trading, I tested this strategy several times, and I actually found a way of avoiding these false signals. Let us go back to step 1. Here we have identified the low volatility period. In order to avoid those false signals, we will mark horizontal levels of support and resistance. This gives us a definitive area which the price must break in order to start a trend. So now, we will buy when the price breaks the resistance and closes above the upper band. Here is our entry. The price breaks the resistance as well as closes above the upper band. We enter here and keep our stop loss below the resistance. For targets, we can exit at 2:1 risk to reward ratio. In this example, the price gave a $120 move to the upside after our entry. Let us now look at a sell trade. Here we have the S&P 500 on the 30-minute chart. Look at this area. Here we see that the middle band is flat, and the Bollinger Bands are narrow. Hence, we have successfully identified an area of low volatility. Now we will mark horizontal levels of support and resistance. In order for the price to trend, it must break this area. Here we see that the price has successfully broken the support, and the close of this candle is below the lower band. This is our entry candle. We will sell the stock after the close of this candle. We can keep our stop loss above the support area, and we can place our targets at 2:1 risk-reward ratio. The price gave an 80-point move after our entry. This strategy is very powerful when used on 15 and 30-minute time frame. But I recommend back testing it before use. Let us now learn the second strategy. The second strategy is called the RSI Bollinger Band combo. As the name suggests, we will use two indicators in this strategy: the RSI and the Bollinger Bands. We will use the default 14-period RSI. Our goal with this strategy is to identify divergence on the RSI and use the Bollinger Bands to enter and exit the trades. First, let us understand what divergences are. Divergences are of two types: positive and negative divergence. A positive divergence occurs when the price makes a lower low, but the RSI makes a higher low. This indicates that the downtrend has lost its momentum, and a reversal may occur very soon. On the other hand, a negative divergence occurs when the price makes a higher high, but the RSI makes a lower high. This indicates that the uptrend has exhausted and a reversal may occur. Every divergence does not result in a reversal. Hence, we will use the Bollinger Bands to identify our entries. Let's now dive into the strategy. The first step in our strategy is to find divergence. Look at this chart. Here we can see that the price has made higher highs. But look at the RSI, it has made lower highs. This is a negative divergence. This indicates that the uptrend has weakened and a reversal may occur very soon. But we will not sell the stock just yet. Instead, we will wait for the price to close below the middle band of the Bollinger Bands. Here is the candle that closed below the middle band. We will sell the stock here. We will keep our stop loss above the upper band, and we will keep our targets at 2:1 risk to reward ratio. The stock gave a 2% move within the next few hours after our entry. Let us now look at a buy setup. We have the Euro-USD pair on a 30-minute time frame. Here we can see that the price has made lower lows. But if we look at the RSI, it has made higher lows. This shows a loss of momentum in the downtrend. Hence, we could see a reversal in price. But we will not buy just yet. We want the price to close above the middle Bollinger Band. Here is our entry, as the price makes a strong close above the middle band. We enter at the close of this candle. We keep our stop loss below the lower band. And we will place our targets at 2:1 risk-reward ratio. The pair gave an 800 pip move after our entry. This brings us to the end of this video. The strategies shared in this video are very powerful. But, I recommend back testing this strategy before using it. See you in the next video.